All right, let's jump right into this explainer and demystify the discounted cash flow model. If you're an executive sitting at the boardroom table, you are constantly bombarded with financial models. But the DCF, it really stands apart. It's not just some tedious spreadsheet exercise, it's honestly your ultimate reality check against market hype for your next big meeting. Today, we're going to take all that complex math your analysts are using and translate it into a crisp, strategic framework you can actually leverage. Here's our roadmap for this explainer. We'll start with stripping away market hype, move to Pillar 1, free cash flow, then Pillar 2, the hurdle rate, and Pillar 3, terminal value. Finally, we'll wrap up with valuing the enterprise and some strategic risks and limitations. Section 1, stripping away market hype, the ultimate reality check. Let's start with the bottom line. Why do we even bother the DCF when just looking at competitor comps seems, so much easier? If you just rely on relative valuation, meaning you price your company strictly based on what your competitors are doing, you're basically at the mercy of market moods. If the market is completely overvaluing your sector, your valuation gets artificially inflated too. The DCF answers a much better strategic question. If this business keeps performing exactly like this, and I want an X% return on my money, how much should I actually pay for it today? It gives you a rock-solid baseline, completely independent of whatever the stock market is doing right now. That's because it's an intrinsic valuation method. It's a reality check grounded in a super simple concept, the time value of money. Essentially, a dollar in your hand right now is worth more than that exact same dollar a year from now, because today's money can be invested and grown. A DCF simply does the math to figure out exactly what all those expected future dollars are worth to your business right at this very second. Section 2, Pillar 1, free cash flow. This is the absolute lifeblood of the valuation. Free cash flow is the real, hard cash left over after the business pays for everything it needs to keep operating and growing. For you, as an executive, this represents the actual strategic capital you have available to either pay down debt or aggressively invest in new opportunities. Put simply, the more free cash flow, the more attractive the company. So instead of staring at a massive, complicated formula, you really just need to make sure your analysts are making these logical deductions to find that true leftover cash. They should start with operating profit, your EBIT, and subtract taxes. Then, and this is crucial, they need to add back non-cash expenses like depreciation and amortization. Why? Because those are just accounting concepts. There is no actual cash leaving the building today for a piece of factory equipment you bought 5 years ago. But they do need to subtract capital expenditures, like buying a brand new facility, because that is real cash going out the door right now. Finally, they adjust for non-cash working capital. If your assets are going up, you're spending cash to buy them, which instantly decreases your immediate free cash flow. Section 3, Pillar 2, the hurdle rate. Right, so we can't just add up all those future cash flows one to one. We have to discount them. And for that, we use the weighted average cost of capital, or WACC. Think of this as your corporate hurdle rate. It measures the blended cost of financing for your company. The main takeaway here is really straightforward. If the investment or the market environment is riskier, this discount rate goes up. And mathematically speaking, when that discount rate goes up, the present value of the company comes down. This beautifully contrasts your financing costs. Your WACC is just a blend of your cost of debt and your cost of equity. Debt is straightforward, right? It's the interest you pay on loans, and crucially, it's tax deductible. Equity, however, is a bit trickier. It relies on the capital asset pricing model, which looks at the market's expectation for bearing the risk of owning your shares. It factors in volatility metrics like beta. As a leader, you just need to understand that your cost of equity is essentially the market's required compensation for taking a risk on your specific business. Section 4, Pillar 3, terminal value. Okay, moving on to our third pillar. We have to address the reality that we can't accurately forecast month-by-month cash flows into infinity. Analysts will usually build a detailed forecast for the next 5 to 10 years. But since your company isn't just going to disintegrate after year 10, we have to assume a value for its ongoing life. That's your terminal value. And pay close attention here because this one assumption often makes up a massive, sometimes the absolute largest, portion of the company's total valuation. You'll typically see your team use one of two methods to calculate this. The perpetuity growth method assumes your cash flows will just grow at a steady rate, literally forever. Best practice here is tying that growth to something realistic, like the overall GDP of the country. The alternative is the exit multiple method. This one assumes the business is virtually sold at the end of the forecast period, using a multiple, like EV to EBITDA, borrowed from comparable companies, say Google or Microsoft. Honestly, a really solid model will often average the results of both methods just to keep the valuation completely grounded.
Section 5. Valuing the enterprise.
Now let's pull all three of these pillars together into the actual chronological workflow your finance team executes. First, they forecast the free cash flows. Second, they calculate that WAC, the discount rate. Third, they calculate the terminal value for the years beyond the forecast. And finally, they discount it all back to present-day value. Oh, and here's a quick pro tip to look out for. Top-tier analysts will often use a mid-year adjustment. They do this because cash flows happen dynamically throughout the whole year, not just in one giant lump sum on New Year's Eve. Discounting them from the middle of the year just makes your valuation significantly more accurate. Once all those discounted cash flows and the terminal value are summed up, you get your enterprise value. But you're not quite done yet. To find out what the actual shareholders own, the equity value, you take that enterprise value, add back the cash sitting in the bank, and subtract the short and long-term debt. Divide that final equity value by your outstanding shares, and boom, you have your mathematically implied share price.
Section 6. Strategic risks and limitations.
All right, let's move to our final section. This is where you, as an executive, need to rigorously scrutinize the models being handed to you. A DCF is a hugely powerful tool, but it's not magic. Its greatest strength, its extreme detail that forces your team to think deeply about growth drivers, is also perfectly linked to its greatest weakness, the classic garbage in, garbage out phenomenon. Because the entire model relies on forecasting the unknown future, that assumptions will completely ruin the output, no matter how pretty the spreadsheet looks.
Seriously, what happens if our growth assumption is off by just 1%? Listen, if you take absolutely nothing else away from this explainer, that you absolutely must demand a sensitivity analysis from your team. You need to see a table showing how tiny shifts in the model, like adjusting the terminal growth rate down by just 0.5% or tweaking the WACC up by 1%, wildly change the final valuation. You never, ever want to make a massive strategic decision based on a single, fragile, static number.
Also, it's crucial to remember that a DCF is not a universal tool. It requires stable, predictable cash flows to actually work. If you're looking to acquire a fast-growing tech startup that's burning through cash and has negative free cash flows, a DCF completely falls apart. If you ran the math strictly as is, the model implies you would literally have to pay someone to take the company off your hands. Obviously, that makes zero strategic sense. For those types of businesses, you have to revert back to relative valuation and multiples. The DCF model is a fantastic lens for viewing your business's intrinsic power. It really is your ultimate strategic truth serum. But remember, the math is always going to work perfectly in Excel. The spreadsheet won't throw an error just because your revenue projections are wildly optimistic. It is your job to question the business reality behind those numbers. So the next time you're handed a valuation in the boardroom, ask yourself, are you rigorously stress testing the assumptions your analysts are feeding it? Because at the end of the day, those assumptions are what truly dictate the value.